All right, so welcome again, right? So today's topic is supply and demand. Probably one of the most important confluences we're going to learn, and also one of the most time consuming and one of the most accurate, right? It's basically like the foundation of our strategy, right? So here I have a little booklet that I gave, and I said, okay, read it, so you could get a head start and you could kind of understand what supply and demand, right? Basically, this little booklet is like a little Bible, right? It have detailed information on how to use the strategy and what the strategy is, right? And we want to just scroll through it and see what we could pick up, basically, because I know a lot of people probably didn't have a look at it, for whatever reason. So we will just have a look at it right now. And then we're gonna take it to the charts, right? A quick scroll, nothing too serious. You have the link to this book in the group chat. So on your own timing, every day, you should probably read it. All right. So basically the rules of supply and demand, right? Um, we don't have no indicators. The charts are clean, no volume, no lagging overbought indicators. We don't take news into consideration. We don't take any earnings report into consideration, right? Also, there's like a YouTube channel. You can just type in supply and demand and you'll see like a few videos on it, right? You just scroll through. I mean, you could just read what it says if you want me to stop on anything, but I'm scrolling to the most important parts, right? And like I said, you have this book in your in the group chat, right? So what is supply and demand, right? Okay, so let me see what we have here. The only reason why a price moves in any and all markets is because of the imbalance in supply and demand. The greater the imbalance, the greater the move in price, right? Why do these imbalances occur? The currency market, the financial world in general, is dominated and is ruled by big investors, institutions, central banks, and professional trades, right? They have the ability and the capacity to move the markets with thousands of orders. These orders create the so-called supply and demand imbalances, right? Daily news occurs and affects the world economies. Positive news usually increases demand and reduces supply, leading to higher prices. Negative news usually decreases demand and results in an increase in supply, right? Retail, the retail and the small investors end up becoming the bait, basically the newbies, the people who don't know about supply and demand. The liquidity by the professional traders need to fill many of their orders, right? So basically, what they're saying is, um, the newbies, right? The professional traders use their stop losses to fill their orders, right? So they can't sell if there's no normal buyers interested. Every trader institution has a different perception of a fair price and future value. Supply is simply the amount available, while demand is the amount that is wanted. Supply is the amount available at a particular price, while demand is the amount that is wanted or desired at a specific price. As prices increase, the seller's willingness to sell the product also increases. The opposite of this shows that as prices increase, we see demand reduces, right? Buyers will demand more when prices are lower. Simple. I mean, I think all of us have some firm idea what supply and demand is, but um, when you consider anything in the market, it might be a little different to what you probably have an idea of when you're in school, right? So here they give a real life example of supply and demand. He probably talk about when you go in a grocery store and the price high, if you go buy it, and the price low. You know, you can read that on your own time, right? I think that was it right here. So right here they're saying price is fractal, right? Let me just go through this real quick. Each time frame can have a different trend. In fact, there are multiple trends happening right now on every single instrument that exits. Price is fractal. Fractal meaning that there are structures within structures. The same patterns repeat over and over again on all time frames when we drill it down a candle on any time frame. Many time frame analysis is needed to make a high probability decision. That's why we do multiple time frame analysis, right? Because we need to look at all the different time frames to make a trading decision, right? The best combination for trading multiple time frame analysis are those that are common multipliers. In our case, 4 to 5. Any multiplier or scale can be used, but when we need to keep it consistent over the time frames, we select for our sequence. Remember that Forex is the biggest market in the world. It is traded by professional traders, by professionals and not retailers. A hunter has all sorts of traps to capture its prey. So do the big institutions. So when trying to combat professional hunters as retailers, we are their prey, right? So what they're saying is all stop losses is food for the bigger boys, right? By using, let me see somebody drop by using similar scales and multipliers, we are making sure that the difference between the chosen time frames are minimal. The fractality of candles will match better if we use very different scales for our chosen time frames. This is why using a combination of the weekly, daily, and 15-minute chart makes no sense. The scale factor is broken, right? So basically, you can't jump from the weekly, daily, and then jump to the 15 minutes, right? To get a good understanding, you had to take each time frame one after the other. So if you start from the monthly, you had to go to the weekly, then to the daily, then to the 4 hour, then to the 1 hour, 30 minutes, then 15 minutes, right? And sometimes you even have access to the 8 hour chat, right? So right here we just have a little figure displaying some fractal, right? Basically, this figure will just keep zooming here until so this is an example of what it means for what fractal means, right? But yeah, so all right, so here they're saying after a couple of weeks of back testing, you would see that the strategy kind of works probably more superior than the other strategies, right? Well, here they talk about, you know, controlling your emotions when you're trading. and psychology, right? So you have this, you could read it on your own time. Then they give you the YouTube channel. The guy have some supply and demand analysis. Here they talk about using 1 to 3 risk to reward every time you have the trade. Motivational videos. Here they talk about keeping the chart clean, right? The cleaner the charts, the better. You know, the easier you'll be able to flow through the charts, the easier you'll be able to identify the things you need to identify, right? What you should see on your chart. So basically, this guy, he only trades supply and demand levels, right? So the only thing you'll see on his chart is supply and demand levels, and maybe like a few trend lines, right? So this is kind of what it looks like. It might look like a complicated now, but we'll break it down piece by piece, right? So here they talk about types of levels, continuation patterns, swings, valleys, and peaks, right? Let's make it pretty quick. Let's make a pretty quick summary. There are 4 types of zones we are looking to see on this chart, right? Peaks and valleys, best at the extremes of the range or close to it. It have rally base drop and drop base rally. I'll explain to you what that is in one moment, right? So let me just hop on the chart for me to give you a quick breakdown, right? Let's see. Okay, so here's the idea, all right? Supply and demand imbalances, right? Basically, when the price moving in a certain direction, the price moving because there's an imbalance of buyers and sellers, right? The only reason why the price could move up is because there are more people buying than there are people selling, right? So the market have to move until it reaches enough sellers to either push it down or make the price balance, right? What does it mean for the price to be balanced? It simply means for the price to move sideways or in some form of consolidation, right? So when the price balance, it'll either move sideways like this. Obviously, we know price doesn't just go sideways like that, right? So you go sideways in a consolidation manner, right? That simply means that in this area, the price is balanced. There are equal number of buyers and sellers, so the market cannot go in either direction, right? There needs to be some form of imbalance for the market to have a particular direction to go, right? And that's the idea of the strategy, to trade the imbalance, right? So these are the 2 supply and demand imbalances, right? You have what we call valleys and peaks. Let's see, valleys and peaks, right? Valleys and peaks is gonna look like higher, lower highs and lower lows, right? Basically, this is the peak, right? This is the peak here. This is the peak. This is the valley. This is the valley, right? The one with the points to the top is the peaks, and the one with the points to the bottom is the valleys, right? Pay attention because you know you're gonna have to label this, right? And actually, let me just label it real quick for you. Peak, peak, valley, valley, right? So what happens, right? When the market is at that peak or that valley, the price would be balanced for a moment, right? Because in order, for example, once the price moving up, the price is imbalanced because there are more buyers than sellers, right? Once the price moving down, the price is imbalanced because there are more sellers than buyers. But at this point right here, the price is not moving up or down. At some point in time, the price is not moving up or down, right? For it to stop. So that is that at that point is where the price is balanced, right? And then an imbalance takes place when the sellers or supply pushes the price down. Basically, demand is always at the bottom, supply is always at the top. Just how you have support at the bottom and resistance at the top, you have supply at the top and demand at the bottom, right? So these peaks will be considered supply zones, right? Once they fit the criteria, because there are certain rules to identify them, right? These peaks will be considered supply zones based on how they are formed, right? And I'm taking it slow with this class because there's a lot of little details with supply and demand, you know, in order to master it. So yeah, so these valleys would be demand, right? Because the price come down, it balance, and then it move off, right? Now, in order to classify certain zones, supply or demand, they have to meet certain criterias, which we're going to get into, right? So this is the first two types of supply and demands, the valleys and the peaks, right? Now, we have what we call a CP. CP means continuation pattern, right? That's another supply or demand zone. Basically, the CP is formed when there's a pause in the market, right? A pause that is not a valley or a peak. A pause that is not a higher high or higher low, right? Now, what does a pause in the market look like? So you would have, you might have the market moving down like this. And while it moving down, it pause right here, right? It goes sideways for a bit, and then it continue moving down, right? Now, this pause in the market cannot be classified as a pullback or cannot be classified as a valley or a peak, right? So that pause in the market, we call it a CP, a continuation pattern. Basically, the market would be at an imbalance, and the market would balance for just a moment, right? And then the market would imbalance again, right? So that pause in the market is called a CP, right? It could occur in an uptrend or a downtrend, right? CP continuation pattern, right? On an uptrend, it will look something like you have an uptrend, Yeah, this little pause in the market right here. And yeah, uptrend, right? Okay. So this is a basic explanation on supply, the types of supply and demand imbalances, right? Now, how do you trade them? The idea of trading them simply means, right? Basically, here's the idea. Pay attention. Now, once the price is balanced, right? Let me use this little tool I have here. Once the price is balanced, right? In this little zone right here. That means it has equal number of buyers and sellers. I hope you're taking notes, right? Now, in order for the price to become an imbalance, we need to have a strong impulsive move to push the price out of being balanced, right? And depending on how quick the move is, how far the move go, and how long the price stay away from that imbalance determines whether or not that zone is valid, right? So basically, once the price is balanced, the only entity strong enough to create an impulsive move to push the price away from being balanced would be an institution, right? And how institution works, when they enter the market, a lot of the times they would enter the market and they would have a million orders to sell at, let's say 114, right? Now, based on what going on in the market now, if that entity or that institution has a million cells to enter right here, what might happen is there aren't a million buyers to balance off that cell, right? To absorb that cell, right? No, no. If there's let's say the bank, right? Let's say if the bank is selling 100, let's just make it a simple price, right? Let's say the price is balanced right now, right? Right here. Let's say the price is balanced right now. We have 10 buyers and 10 sellers, right? Just for example, the price balanced. That means it's not going up and not going down, it just consolidated, right? Now, if an entity decides they're going to add 100 cells right here, I just want you to understand the concept so you know why it works, right? If that entity adds 100 cells right there, there are only 10 buyers, right? Because the price was balanced before with equal number of buyers and sellers. Now, if an entity adds 100 cells there, right? There are not enough buyers to absorb that 100 cells, right? So what the market has to do now, the market has to drop its price. The price has to drop until it finds more buyers to push the price up, right? So what might happen? Know that there's 100 cells right there and there's only 10 buyers. That 100 cells go only get only 90 of it, only 10 of it would enter, right? So now you have 90 cell orders still at that zone, right? So what happens is the rest of orders are left as limit orders, right? So basically those orders would sit there until the market finds enough buyers to push the price back up to enter the sell limits, right? So as the market comes down to look for more buyers, people go start buying because they have a cheaper price to buy, right? And as it comes back up with more buyers and it reaches the zone, then the rest of limit orders would activate, right? So if there's still a lot more sells, when the market gets back up to the zone, let's say it gets back up to the zone with 50 buyers, right? So now the price would drop again, right? Because that entity enters so much sales that there's not enough buyers to balance the price. That's why it's called an imbalance, right? Because there's more sell orders at that price. So what we're expecting, once the market gets back to that price and the limit orders activate, we expect the market to continue down because we know there's a lot of sales at that price, right? So whatever is absorbed, the market will continue to drop until it finds more buyers to bring it back up to that zone, right? Now, once the market pushes past the zone, even if it's by 1 pip, let's say this is the top of the zone right here. Once the market pushes past that zone, even if it's by 1 pip, that means that there are no more orders at that zone, right? That means there are no more supply at that zone. So then you don't expect to be selling because you know all the orders was absorbed and there are no more sellers at that zone, right? So that's the concept. That's the concept, right? So that's how you would trade the peak, right? You would be selling at the peaks if it's a downtrend because you're expecting demand to be removed, right? And you would be buying at the valleys if it's an uptrend because you're expecting supply to be removed. Now, when it comes to the CP, it's the same concept, right? Basically, on the market drop and you have that pause in the market, you know you have a supply imbalance right here. So when the market comes back to retest that imbalance, you would enter short, right? Basically, your stop loss, your entry would be right below the zone, and your stop loss would be right above the zone because you know the market not supposed to come above the zone based on the imbalances that's there, you know. So yeah, you would enter short. The reason why it's called a CP, a continuation pattern, is because it's like continuing, the trend is continuing. So it's just a way to enter the trade, right? So and that's just like a quick, well, not really quick, but a basic kind of explanation on the types of imbalances and how you would trade them, right? Now we are going to get into how you would enter into a continuation trend and how this supply and demand strategy would help you spot trend reversals as they're happening, right? So just a quick go over a supply and demand zone. Remember earlier on I was reading rally base rally, drop base drop, and let me just write it up, and rally base drop. So you have rally base rally, right? Make this bigger. Right. So you have rally base rally. What that means, rally, the price rally, the price base, and the price rally, right? This is simply a CP, supply and demand zone, right? Continuation pattern, supply and demand zone, right? Yeah, this consolidation. And obviously, what you're waiting on is for the price to come back to retest the zone to go long, because you know there's an imbalance of demand here, imbalance of buyers. So you know there's orders here, depending on how the price leave the zone and how the base was formed, right? So this here, this impulse is called the rally, right? This this pause in the market is called the base. And then this other impulse is called a rally, right? There's one type of supply and demand zone, right? So after a rally, base rally, you have drop, base, drop. It's simply the opposite, right? You have the market drop, base, sideways movement, consolidation. The price is balanced, drop. Now the price is not balanced, right? So this would be the base. You have a certain candlestick formation for that base. And then this would be your drop, right? Your departure, right? This is the price leaving that that zone, right? So this would be a drop base drop, right? So rally base rally, drop base drop, right? So next we have rally base drop, right? So basically, the market rally, base, drop, right? Rally, base, drop, right? So the idea here is this is your impulsive move up. This is your base, and this is your drop, your departure. This is the market leaving that zone, right? That's probably going to be a peak, right? So you know if the price was in a downtrend, you might have that rally base drop, right? And then when the market comes back to retest the zone, the base, the imbalance, you would go short at that location, right? And then we have drop, base, rally, right? These are the four supply and demand imbalances, right? So as you would imagine, drop, base, rally is drop, base, rally, right? Now sometimes the base is just gonna look like a point, a pick, but when you break it down, like we said with the fractals, you would see the candles basing at that valley or peak, right? So here you would have the base, you would have the drop, and here you would have the rally, right? Now this is just a basic concept. A lot is taken into consideration when validating these zones, right? Basically, you have to consider how many candles was at the base, how the market left the base. You know, a lot of little rules you would learn as we go along studying this strategy right here, right? So before I get more into it, anybody have any questions? All right. Well, I guess you almost understand the strategy very well. So, like I said in previous classes, you know, me doing this in front of you, it looks like a piece of cake, right? The moment you have to do it on your own, it's very hard. Yeah, so CP zones is basically consolidation, right? Consolidation is basically the price being balanced, right? So let's I'll just, with the basic knowledge we have on this strategy, we'll just scroll through the chart and try to identify some CP zones, right? Some valleys and peaks and some CP zones, right? Okay, so this right here would be considered a CP zone. Just for example, just a live example. We had a drop, base, drop, right? Market came back, we tested the zone where you would sell. Let me see if I can find an example for every scenario, right? This strategy is mostly used on the daily time frame. So that's something we have to take into consideration, right? So this would be an example of rally-based rally, right? Basically, I had the market rally, base, drop, right? So what you would do, once the market comes back to retest the zone, you would enter a little early. So the market didn't retest it on the first try. On the second or third try, it did, right? So we know the longer the market stays away from the zone, the more money was poured into the zone, right? The further away the market goes from the zone, from the imbalance, the more money that's at that imbalance, right? So here we have an example, and I mean, I just giving you some quick examples, right? I haven't taught you how to validate these zones. I haven't taught you how to properly identify them, right? I just explained the concept, right? So here we have drop, base, rally, right? So this should be your demand zone right here, right? Basically, if we drop down on the lower time frame, let's see. On the daily time frame, the market was consolidating in this zone. So that's where we had our drop, base, rally, very strong impulsive rally. So we knew, okay, some big money there, you know? So when the market came back to retest the zone, you go long, stop loss below the zone, right? So we had an example of rally base drop. We had an example of drop base rally. We had an example of drop base drop. So let's see if we can find rally base rally, right? So here we have what we call basin candles, which we'll be going through in the next lesson. Basically, a basin candle is a candle that its body is less than 50% of its of the entirety of the candle, right? So we know that a candle is made up of this was okay. So this is a candle, right? If it's a bearish candle, this is the open where the candle opened right here. This is the close where the candle closed right here, the edge of this body. This is the wick, right? Right? This is the body, right? And this is the entire candle right here, right? So you get the idea. Anyways, you get what I'm trying to say. This is the entire candle. So the entire candle runs from the top of the wick to the bottom of the wick, right? Now, in order for a candle to be considered a basing candle, the body has to be less than 50% of the entire candle, right? Now, the body has to be less than 50%, right? So what that means is out of the entire candle, the length of the body has to be less than 50% of the candle. Now, this candle right here, we could tell that, okay, the body is definitely not less than 50% because we only have this little bit of wick taking up maybe 20% of the candle. This candle here, the wick's taking up maybe 5% of the candle, right? But these candles right here, look at the body. We know that this body is definitely not half of the entire candle. Same for these, right? So same for these, right? So once the body is less than 50% of that candle, then it's considered a basing candle. It's considered consolidation, right? Because if you drop down on the lower time frames, you would see it consolidated, right? So basing candles are at valleys and peaks. You need to have basing candles at valleys and peaks. Sometimes there aren't any, but that's the idea. Basing candles simply represents price being balanced, simply represents consolidation, right? So you have to practice to be able to identify basing candles. So here we had a rally, base, drop, base, rally, right? So here we had 1, 2, 3 basing candles, right? So I'm just going to draw this from the body of the top basing candle to the wick of the lower basing candle, right? So this is the base. This is the rally base rally. So like I said before, the idea, once the market comes back, retest, we go long. And in the beginning, I said price is fractal, right? So what that means, you would find supply and demand levels on every time frame. But the lower you go in time frame, the lower the probability. The higher you go in time frame, the higher the probability, because we know the larger time frame rules. All right. So this was just a nice little introduction into supply and demand. I think I explained it very well, and we're gonna be working on this for the next couple of sessions. at least the next 5 sessions, because supply and demand is a whole other world that is new to a lot of traders. A lot of traders don't know about this strategy. A lot of traders don't use it. A lot of traders don't understand what actually moves the market. What actually moves the market is supply and demand, right? What actually creates the patterns is supply and demand, right? So this is just a quick, well, not a quick, but a basic introduction, and we'll be definitely diving a lot deeper into it. And we'll also be practicing the strategy, back testing the strategy, and if you look at my signals, you'll definitely see that we have that strategy in there, right? So we had 50 minutes now. If you don't have any questions, we're gonna end the class right here. All right, so before we go, right, I hope everybody was taking notes. So I want everybody in this class, and every time I say everybody in this class, only 2 people let's do it. If you want to get better at this, you have to do your homework, right? The lessons aren't for you to watch once. You have to watch it over, make notes, practice, and make sure what you're learning making sense, right? So what you want to do, write out the 4 different supply and demand zones, draw them out, label them, even if you had to draw it on paper, right? And read the booklet. Read the booklet. Read the booklet, right? It'll take you like half an hour to read because it's short, but you have to read it a couple of times. And the more you read it, the easier my job gets. So I don't have to explain stuff over and over, You want to get this easy. So yeah, I wish you all the best. And I'm definitely looking forward to the next class because this is a very exciting topic. All right. Have a good night.